Well, hey everyone, welcome to our webinar. I'm Josh Collins from REO Success TV, and thank you so much. This is going to be a very interesting discussion. Our webinar today is entitled, Now That the Election Has Been Decided, What Will Happen to the Real Estate in the Future? And so we're going to talk about the rest of the year, 2013, 2014, and what's coming up. We've got some incredible guests with us today that are just experts in the market. They know what's going on. And so this is going to be a spirited discussion. It's going to be a fun discussion. And most of all, it's going to be a discussion that will help you to know where you need to position yourself in the market for the things that are coming up. So I first want to introduce Brandon McKnight from PMH Financial. Brandon's been a friend for a long time. He is a student of analytics. He looks at the market all the time. He's messing around with different marketing things and trying to get his finger on the pulse of what is happening right now. So Brandon is an awesome guy. He's like I said, he's a good friend, but he's also a scholar. So Brandon, I just want to hand it over to you. Thanks for being with us today.
Thanks, Josh. I appreciate it. As you guys know, I've been working with Stewart Lender Services for the past year now. Most of my focus has been on helping agents better understand the market and adjust to it, and basically be more efficient at selling homes and growing their business. So with that in mind, partnered with REO Success TV to help produce this webinar. And on today's panel, we have Scott Gillen, Scott Sambucci, and Darren Bloomquist. And without further ado, I want to allow them to introduce themselves and give their backgrounds. And we will go ahead and start with Scott Gillen.
Yeah, good morning. Thanks, Brandon. My name is Scott Gillen. I'm the servicing executive at Stewart Lender Services. My background is primarily loss mitigation related and servicing related, as well as origination operations. I manage the group at Stewart that does all loss mitigation related work, short sale work, as well as support work for servicers on other levels.
All right, thank you, Scott. Scott Sambucci.
Hi, Scott Sambucci. I work with the CoreLogic Advisory Services Group. So we sit atop all of the different product groups in the CoreLogic enterprise and create custom solutions. We do consulting for GSEs and other financial institutions, basically going about answering questions whatever market problems or issues they have with regard to their portfolio. So obviously a lot of the work we do is looking at loan position from a lien standpoint, looking at optimal disposition strategies, and looking at policy implications.
Okay, thank you, Scott. Darren?
Yes, I'm Darren Bloomquist, Vice President with RealtyTrac, and really I'm in charge of issuing our foreclosure reports that we put out. We've been putting out since 2005, tracking what's happening with foreclosures, with REOs specifically, as well as foreclosure starts and foreclosure sales of foreclosure properties. So I'm neck deep in the numbers every day, looking at those.
Yeah, actually, that's actually a perfect segue, Darren. I'm gonna pick on you first because I was doing my homework yesterday, and you guys actually predicted who would win the election based on whether or not your home value was or home prices were better or worse 4 years later. So let's start with you. And how did you guys? I felt like that was pretty bold. I thought it was interesting that you guys came to market with that. But tell us a little bit about that study and that report that you guys produced.
Sure. Yeah, we thought we tried to have a little fun with it without hopefully people taking us at our word too much. But we felt like the data was there to support a pretty strong. The numbers indicated that if you looked at the housing market and how the housing market is doing, and we specifically focused in on the swing states, the 8 swing states that most people consider swing states. If you looked at the housing market now compared to 4 years ago in those states, it was pretty clear that there were at least 3 strong states where the housing market is better off than it was 4 years ago: Ohio, Virginia, and Nevada. And we felt like if people voted based on the housing market in those states, Obama would probably win those states if you assume that someone who thinks the housing market is better off than 4 years ago is going to vote for the incumbent, which is the assumption that we made. And so we felt like the housing market had improved in those 3 states, And those 3 states alone made it enough to put him over the top in terms of a victory. And we actually predicted that Romney would take the rest of the swing states, which we were wrong on that. But even with the rest of the swing states, Obama would have, without the rest of the swing states, Obama would have won the election. And so we threw that out there a couple days before the election to get the conversation going. I mean, our goal there is that we felt like the housing market really hadn't been touched on very much during the debates, during the campaign, and so we felt like it would be a good thing to get that conversation going, even if it was in the last week, and get people thinking about that most important asset, that their house, and so that's what we found.
All right, so that brings up an interesting question for me because, and it looks like we lost Scott's video, and I'm sure he'll hop back on. But the question that I have, I mean, obviously we know that the housing industry is just paramount to the economy of America, and now, of course, you know, you guys over there at RealtyTrac have predicted the election would basically ride on how the economy or how the housing industry was. I would just like to get both of your or all 3 of your perspectives on, you know, what do you think will happen now that, you know, there's been a little uptick in states like Ohio, Virginia, Nevada, and, you know, but overall, it's taken a long time to foreclose on properties. You know, states like Florida are still over 600 days to foreclose. New York is even longer than that. You know, what do you think is next? The question everybody's asking is, you know, are we going to see this crazy shadow inventory we hear about? But let's not even think about the shadow inventory. Just in general, what do you think will happen with, you know, the housing market in the coming, you know, year to 2 years?
Yeah, I'd actually like to take that one. So I sort of theorize that the court system that we have and the government incumbency around foreclosures has actually been the single best thing for the recovery. Because when you have a case like Florida that's 600 or 900 days or however long it is, or New York, then the investors, whether they be Fannie, Freddie, or the hedge funds that own these loans, they then have to do something, right? Because it doesn't make sense to have a house vacant in Florida for 900 days and then figure out what to do with it. And so by forcing that decision upon the investors to find an alternate route to get out from under that house as an investor and for the borrower, then what it does is create this recovery scenario where you do have the inventory is relatively low. You have now a preponderance of short sales, and those short sales themselves, when the crash started 5 years ago, we didn't have, as an industry, the level and the amount of technology that we have now. We weren't talking about big data. We weren't talking about platforms. We weren't talking about how to integrate all of these different data sets to make better decisions. And so you have this convergence of poor policy on the government side, forcing the hands of the investors and the borrowers, and then you couple that with now the ability to make better decisions faster, and that's what I think is actually contributing to the short-run recovery.
Yeah, I would jump on that and agree that this whole strategy that's been somewhat mocked of delay and pray with the foreclosures has actually ended up working, maybe by accident, you know, because it has held foreclosures off the market and allowed some of those markets to stabilize, and also forced lenders and servicers to come up with alternatives and creative alternatives. And short sales is one of the big ones there that we're seeing very big increases in short sales that are happening even before the foreclosure process starts. And so lenders aren't even bothering to file that initial foreclosure notice. And in a state like Nevada, where it's now much more difficult to file a notice of default, the lenders are instead just going directly to the short sale, it appears, based on looking at, we're seeing a over 40% increase in those, what I'm calling a no default short sales in Nevada, and we're seeing that repeated in other states across the country. And that makes the short sales have a less of a negative impact on the market. They still have I would argue they still have a negative impact on home prices, but not as much as a full-fledged foreclosure and bank repossession. So that's worked. I think, you know, talking about those 3 swing states, Ohio, Virginia, and Nevada. Nevada, it has, over the last year, it has really been that delay and pray strategy by delaying the notice of defaults Virginia is a totally different situation where there is a very fast foreclosure process, one of the fastest in the nation. But in looking at their numbers, I mean, there's some other things going on there, but it appears that they really got through the bulk of the foreclosure problem early on in 2008, 2009 because of that shorter foreclosure process. So that also works as a strategy, depending on the state. And of course, Virginia has some better, especially Northern Virginia, has a much stronger economy than somewhere like Nevada because of the government complex there.
Sure. Now, Scott Gillen, I know you had dropped off. I'm not sure if you heard the audio. The original question was, just give us your perspective on where, what will the real estate market in general, what will it look like for the rest of the year, 2013? What do you, I hate to use the word predict, but, what do you see, coming up? And I know, from Stewart's perspective, you guys, you handle a lot of the servicing, in the mortgage side and title, and, you've got your hands on a lot of different things. So I'd love to hear your take on that. Where do you think things are headed?
Yeah, and I did hear the audio. For some reason, I lost the connection on the camera. I think overall we expect to see this slow state of correction that we're already seeing. The comments relative to the slow foreclosure process. If you asked me 15 months ago, virtually every lender we were working with and managing short sales for predicted declining volumes for all of 2012. A lot of that was, because of the delays in the court systems, the robo-signing issues, the slowdown related to the consent orders, as well as the OCC oversight. Every single loan was going through, a dot the I's, cross the T's review, belt and suspenders review to ensure that everything was done correctly. The byproduct of that, I think, was a realization that it gave the lenders more time to look at the customer. They were making second and third and fourth and eighth outreaches to customers to try to make sure that everything is done correctly before they go into foreclosure. The other thing that we're starting to see a lot of right now, and I can tell you from February until November, we were predicting a big drop in the number of short sales. About June, they started to pick up. And we started staffing additional staff to manage them. And we believe the reason for that is that time delay, the ability of the servicers to go back and continue to work a file and make sure they've done everything possible, as well as the realization, especially in the judicial states, that the best thing for them to do, because the court systems are so slow, is to get a hold of that asset. So they've doubled up their efforts to try to contact customers who have vacated houses. They've doubled up their efforts to try to offer deed in lieu and any kind of short sale offer. They've really tried to incent customers and educate customers on the fact that they still are responsible, they still have risk associated with that property, even if they're not living in it. Try to educate them that they do need to try to do the right thing to try to get that house liquidated without going through a foreclosure. And we continue to see it spike, and we anticipate that process will continue through next year. As far as the housing market in general, I think you're going to see pockets. You're going to see areas where, as foreclosures get caught up, you're going to have some excess inventory. But I think the banks and the delay in process has allowed for a reasonable release of product into the market that has allowed a slow growth in value. And as long as that continues to happen and it's in line with, the consumption abilities in those individual markets, then I think we'll continue to see that growth.
I think that's a great point. It's actually a really strange year because in terms of just anticipated some of the increase in pricing. So that some certain areas are seeing, and so it's actually having it's kind of this weird impact on consumers. We obviously know that consumers are they're not as informed as we are being in the space, but they read and watch publications as much as anybody else, and when they start seeing that home prices are ticking up, there's a general change in the sentiment that is what's taking place in real estate. So with that happening, how do you guys see, now, we've got builders are going crazy, doing as much building as they can to try and supply that inventory that is kind of not there and being held back. How do you think that is going to impact the market going forward with kind of this change in mentality that home prices are going up, I may have missed the boat, I need to buy today because those good deals are no longer there? Do you think that that's going to continue, or do you think that now that with the current, the president staying in office, will that maybe subside or be subdued a little bit? And I'll just open it up, whoever wants to start.
Yeah, if you guys don't mind, I'll jump in there. I think consumers are the most well-informed because they're the ones that live in the neighborhood. I mean, I walk my son every day, nine-month-old baby, and we just walk the neighborhood. And I know exactly what's for sale. I know when the new house comes on. I know when it comes off the market. I know that there's like 3 houses for sale in my neighborhood, and the ones that were on the market, they sold quick. So I feel like I know really well my little neighborhood. And so if I'm in a situation where I want to go do a move-up now because I have a new baby, then like as soon as the house comes on the market, I'm going to go after that one. So you take that into account that the consumers, I think, do see the opportunity. I mean, I find 4 years ago when I bought my house, it was we closed on September 30th of 2008, and I couldn't, for the life of me, figure out why it was so hard to get a mortgage. Because it was personal, right? Everyone laughs when I say that. But now, we went through in 2010, 2009, I sat down with my wife and said, I think we should just sell and go and rent. And now 2012, I'm on websites checking out what's for sale right now because I'm thinking about, geez, for interest rates as low as they are and the bang for the buck that I get, we can go get a 4-bedroom house now for only an increase of maybe $500, $600 a month on my current mortgage payment. So, you take that situation, and then the other piece to this, if you look at it historically, I mean, the crash started back in 06 and 07. I mean, we're 5-6 years into this. And the short-term effect of that immediate crash in 2007, 08, 09 was that you had this cohort of what would be new first-time buyers entering the market, and they all just completely backed away because they saw their parents lose everything when their parents had a second house in Arizona and that thing crashed, or they couldn't get a loan or couldn't get a job, so why would they buy a house? So they decided to rent, and then you have the Facebook generation of people who just have a preference to rent longer than jump into a house when they're 24 years old. But now we're 4, 5, 6, 7, moving into 7 years of a cohort of people that haven't bought a house, and now those people are married and have a kid, and now they're realizing like, okay, maybe I should buy a house. So you do have some pent-up demand there. So you couple that with the low inventory and the interest rates, and then all of a sudden, boom, that's why you have, I think, some strength in the market.
Yeah, I would agree with a lot of that. We have a shadow demand to go with the shadow inventory, and so really the shadow inventory has not become so much of an issue. But it's not. This is going to be a halting recovery. I think we've seen a few really good, strong months in certain areas with home prices increasing. But now on the flip side, we're also seeing in our data, at least in some states, some pretty big increases in foreclosure starts. That the banks aren't completely done with this. They've held back. There is some of this pent up, shadow inventory that's out there. It's not going to flood the market. It's not going to overwhelm the market, but it is still there, and it's going to come out in pockets and batches in different states at different times. And so, especially the judicial states you guys have mentioned, we're going to see these batches of foreclosures hit, and in the next, I would say, 6 to 12 months, we've been seeing the increasing foreclosure starts in the first 9 months of this year. That's going to translate into either short sales or foreclosures in the next 6 to 12 months, and then if they become foreclosures, a sale of a bank-owned property in the next 12 to 18 months in many of those states. And so there is that is all going to lead to kind of a stutter step or sawtooth recovery in terms of home prices, and it's not going to be just skyrocketing exponential growth in home prices, which I don't think anybody's expecting, and I don't think would be healthy for the market. But if, concerning that question of consumers being worried about missing out on the bottom, I think that feeds the psychology of wanting to buy. But also, the good news for those consumers is there is going to be a long period where you're still going to be able to get a home at a pretty affordable price, considering the still low prices and the low interest rates. So that's going to last, I think, at least through the next 12 to 18 months as this shadow inventory, which is, again, not a huge threat to the market, but it still has to be absorbed by the market, and that's going to come out over the next 12 to 18 months and continue to help to tie down home prices?
Well, I think also in the key markets, the affordability index is better than it's ever been. So, while a lot of folks stayed on the sidelines, they can't afford a lot more house than they could have 3, 4, 5 years ago, and that's going to cause people, to start to get back into the market. The builders, the building starts are out there. We're going to continue to see that, but the life cycle of that takes time. I mean, they start building houses. They're going to start to create inventory. I think as long as these foreclosure starts generate a fair balance of actual REO properties that make it through, as well as force the borrowers that have been on the sidelines, for all intents and purposes, not contacting their lender, but forcing the hand, so to speak, and forcing them to start to think about, hey, what am I going to do because this foreclosure is real? As long as that balance is good, I think we'll be, in most markets, be okay. And I think, while it's not publicly spoken, I think the banks have done a good job of releasing inventory in line with what the individual market's consumption rates can be. And they haven't flooded the market the way it was in 08 and 09 when we did have a lot of REOs flooding quickly.
The last 5 or 6 years, have been so about foreclosures. Realtors all want to be in foreclosures, especially, several years back. And a lot of our audience right now that'll be watching, they got into foreclosures. Some have been in it forever, 20 years, but a lot of the realtors that got into the industry 4 or 5 years ago did so because of the promise of foreclosures. And, now inventories are down, new assignments or referrals, as some people call them, are lower. There are a lot of even outsourcers that popped up to try to handle, bulk sets of properties, for servicers and GSEs. I wonder if you guys would be willing to speak to that. Do you think that that in the future foreclosures will be, let's say the immediate future, and then even the short-term future, 4 or 5 years from now, will be a force to be reckoned with? Or would your advice to real estate agents be diversify? Hey, look into this specific part of the industry. I know all three of you have mentioned short sales already, and I'll have a follow-up question to this as well. But what would your advice be to an agent who 3 or 4 years ago was doing very well, had a lot of foreclosure listings, but now has seen that dwindle down to the point where they're looking at other avenues to make a living for them and their family?
Well, I'll make a comment. I would draw the comparison to, being the mortgage guy on the panel. I draw the comparison to being a loan officer. It's easy to go chase refis, and it's easy to go chase low interest rates and see your pipeline go, balloon and skyrocket to where you've never seen it before. But at the end of the day, that's the gravy. That's not what feeds the kids. So I think you have to have you've got to continue to look for the quality business. To the extent you can work in the REO space, assist distressed borrowers, and have an expertise around that, there's a need for that. And we need the agents out there to continue to work with those borrowers and help get those folks properly allocated in whatever workout options available to them. And we need them to help provide the support we need in the local markets on the REO side. But that being said, as this market comes back, they need to have a strong balance of typical purchase business, and they need to continue to work in what is a normal model. Like everybody else right now, if you look at our industry as a whole, a lot of the outsourcers, a lot of the title companies, a lot of the service providers out there moved to the servicing side of the house in 07 because our market went away. We also recognize, though, as the market normalizes, we have to change and go back to a much more of an origination-centric market as it defines itself again. And I think the agents need to look at it the same way.
Yeah, I would say that, foreclosures, as far as I know, are going to always be with us. They're never going to completely go away. And so there's always going to be a niche market for those realtors who want to specialize in foreclosures. And many of those are people who promote themselves on the RealtyTrac website as foreclosure specialists and have been doing this for a very long time. But some of them have been doing it in just the last 5 to 7 years. And I think there's an opportunity in the next 12 to 18 months still where there are going to be markets where REOs might surprise people and come back on. And I was just talking to some agents in Chicago, and that's one market where that's the case, where they are seeing the banks finally push through some of those REO listings, and they're seeing more REO listings come on the market. And so I would say don't abandon the ship yet in terms of REOs. But I think the other piece of good news is for these people who have been working in the distressed market diligently and doing a good job and taking care of their customers, they're in fine shape because they've created a base of customers who are going to be clients for life, whether or not they're going to be dealing with a foreclosure in the future. And a case in point, talking to a realtor in Seattle, talking about this phenomenon, the boomerang buyer phenomenon, is he's dealing now with, he started in the distressed market, I think it was around 2005, where he actually got into real estate. And so all he's ever known is the distressed market, but he wants to do this long term. And he's now dealing with people who he helped do a short sale back in 2008 and 2009 are now coming back and are buyers for him. And so those people, I think those realtors are in good shape if they've done their job and done a good job to almost seamlessly transition into this new market that we're entering into that's not going to be so foreclosure laden. And so I think those are a couple opportunities for agents going forward.
Yeah, on the agent side, you know, as I was listening to the other guys, you know, two things come to mind for me on the sell side. So if you're looking to get listings, I think that going into the winter months here is a good opportunity to dive into some data and understand the markets and even down to the individual homes that may have been underwater or close to underwater, that because of the short-term bounce that we're getting, maybe those folks are, you know, LTV much closer to 100 or even under 100. And you could find some pent-up demand there. People like me that I use myself a lot as an example where, you know, if a realtor came to me and said, look, you know, on the buy side, there's tons of opportunity. I can help you get the maximum value out of your house. You know, do that farming early, do the research, but that means going, you know, whether it's into your MLS or going to public records and finding individual houses, find out when they sold and at what price they sold, and trying to figure out for yourself what the LTV might be. Based on what the mortgage rate that person has, you can make the assumption that maybe they refied 3 years ago, and then do a little back of the envelope calculation and find out for yourself. And, you know, whether it's door knocking or mail campaigns or whatever, go reach those people, because I think you'd be surprised to know that there is this pent-up demand that you're not going to find by just doing the blast, you know, doing blog posts or big email campaigns. So that's one way I think you can find listings, and then alternately I think you'll end up finding buyers of the same way by going and doing the research and looking at places where people are renting. You know, a lot of the single-family homes are now being rented out. So go talk to those people. Find out if there's a reason that they really want to rent. Do they want to rent because they don't have enough money for down payment? Do they want to rent because they're temporary in that city? Or do they want to rent because they're just waiting it out? And you need to have those conversations. And if you don't go do that, it's still a people business, and it takes a lot of work and it takes a lot of research. But if you do those things, I think you can be successful outside of whether or not you feel like REO is going to be a big channel for you or not. It's hard to focus on multiple things in a business. So you can be really good at REOs, or you can be kind of good at REOs and try to get a bunch of other listings other places, and then you end up trying to be all things to all people, you end up being nobody to everyone. So, you know, figure out where you want to be in terms of where your business is. If you want to be an REO agent, then dive in heads first. If you don't, then I think there's a lot of opportunity if you're using data and you're using analytics the right way.
So here's the follow-up question. And this is a little bit more specific to the REO, you know, the future of REO itself. You know, the shadow inventory, we've been talking about it for years and years. You know, I personally have been in REO. I was and am, and, you know, I own 15 offices that specialize in REO or have in the past. And, you know, we've been hearing about shadow inventory, you know, 1.3 million, and now it's, I don't know, 1.9, or one of you guys could tell me the exact number, what it is right now. And the real question is, sometimes I feel like it's like an episode of Storm Chasers, you know, like we're going to go find this tornado that's out there somewhere, but who knows where it is. I mean, that's like the shadow inventory to me. It's out there, it's getting bigger, but nobody can seem to find it. And so, Darren, to your point earlier, you said it's caused kind of a pent up demand and a shadow demand, and one thing that I've seen, and I'd like to get you guys feedback on this and how it may affect or change the face of the REO foreclosure market, or maybe just the real estate industry in general, is that we're seeing a lot of non-performing notes that are sitting there, and now investors are looking to buy them, and you're seeing hedge funds, private equity capital groups get into the game, and they're buying not bulk lists of foreclosures, but they're buying these non-performing notes. And I've talked with some of them and heard from other experts in the industry. It gives a great opportunity for loan modifications. It gives a great opportunity for short sales, and ultimately, even for foreclosures. But so to my question, how do you think that the private equity, hedge funds, capital groups, how will that change the face of the market, the REO market specifically, and then maybe just more broadly the real estate industry?
Our group at CoreLogic works very closely with a lot of investor groups and hedge funds, and also the banks that are selling these notes. And while those notes exist, there's also a dearth of inventory in that place as well, because the banks don't want to take write-downs. So what ends up happening is a lot of times these pools go out for bid, and they end up getting overbid, and people end up overpaying for those. So then they're looking for places where they can make margin on their purchase, and a lot of times it's trying to find more creative resolution or disposition strategies. So that's the case where, if you have this note and it's non-performing and it's in Florida, you're not going to sit around for 900 days to wait for it to foreclose. You're going to go try to find some kind of creative way to figure out what's going on with that borrower and try to find a workout situation. So I know a lot of agents are always looking for relationships in that investor area, and it's really hard. It's hard to find. It's hard to make connections with people at Morgan Stanley or Chase or Citi. But at the end of the day, when I talk to these traders, I was at a conference a couple of weeks ago. I sat down to lunch with a guy from Amherst, and he flies to Atlanta and walks houses. That's what he does. That's how he figures out what he's going to buy. These big pools of 5,000 loans aren't out there anymore. He's buying 10 at a time, 5 at a time. He's trying to figure out where to spend his money that's been given to him by investors. And so those guys are out there. They want to get on the ground, and when they can't get on the ground, they need a reliable partner. There's another fund I know that's based in Australia. They set up an office in Dallas because they're buying REO to rentals in Dallas and Cleveland and Pittsburgh. So, the money's out there, and these guys need the local knowledge. So, however you feel like you can reach those people and show your expertise in these local markets, they will take it, and they will talk to you if you bird dog them hard enough.
Yeah, I agree with Scott.
Sorry, go ahead.
Well, what I was going to say is for 5 years, there's been funds popping up saying they're going to buy a bunch of distressed mortgages. The reality is the banks aren't going to take the hit. It's a small percentage of it. Yes, to the extent that they do get sold, that there is more flexibility to do creative workouts, but you don't see the growth in principal reductions. You don't see the growth in the retention options because of that, simply because the banks aren't going to let them off the books at the discounts that a lot of these guys are looking for. So that being said, real estate's a local thing. It's a local market. There's no such thing as a national real estate market. So these guys need expertise on the street. They need to know, down to the MSA. They need to understand what's going on in the neighborhood, and that's where the agents provide more value than anybody else out there, is being able to support them. I've heard more stories than I can count of guys who literally, it's the small investors that are surviving. They're walking into an area of the country, literally, getting to know the neighborhoods and making a decision that this is an area I'm willing to invest in. They're not just blanketly buying properties all over the country. They're being very, concentrated in doing their due diligence on where they think their money is best spent, and they're buying 20, 30 properties or 20, 30 loans at a time. They're not out there buying tens of thousands of them.
Yeah, I would just add on that has helped this trend of institutional investors, whether they're buying the notes or the actual properties, has helped soak up this much feared shadow inventory you were talking about, and that's one of the reasons that it hasn't been as much of a threat to the market as many anticipated. I think one of the maybe unintended consequences of this trend, however, is you're going to see that it's prolonging the resetting of the market in a sense. So you have these investors buying up these pools of loans. They eventually are going to have to foreclose on some of those. Some of those are not going to perform still, and so that that will kind of prolong this. I don't want to call it a foreclosure crisis, but the unwinding, unraveling of the housing bubble that burst, and so that's one consequence I see of that is it is going to prolong foreclosures, high levels of foreclosures for a little bit longer, but the high levels of foreclosure are not going to be detrimentally high to the market.
Yeah, and to add to that even further, what Darren just said, I mean, Scott mentioned before about it being a long, slow recovery, and bringing it back to the idea of the election and policy and what's going to happen next. I think that when everything crashed, at the end of Bush and moving into Obama, there's all of these programs, HAMP and HARP, and trying to figure out how all those are going to work. And each of those kind of chipped away at the edges a little bit. It's kind of like watching an ice cube melt. It just kind of happens, little by little, and all of a sudden you realize you got a pool of water sitting on your table. So, I mean, those programs and policies, I don't think there's anything else that could be done, and I don't think there's any desire, whether it's from Congress or the executive branch, that says we need one more policy and that's going to be the magic X alert to solve the problem. I think we're kind of policy. I think, we've run the course in terms of low interest rates plus HAMP, HARP, HARP 2, HARP 3, whatever. Like we talked about, the short sales are here. You've got the cohorted demand. You've got the rental market. I think everybody's at a point where they just kind of feel like the wheels are in motion. As of today, he's frankly a lame duck president, so he doesn't really have to do anything because he doesn't have to worry about re-election. So let it run its course. In 4 years, I mean, if 4 years ago, if we would have asked each other and said, look, in 4 years from now, this is how the housing market's going to be, everyone here would have taken it. We'd be like, heck yeah, we'll take that in 2012. If you're asking me in 2008 that we'd be at stable, rising prices, some markets are good, low inventory, everybody go, heck yeah, I'll take that. So I think 4 years from now, in 2016, the market's definitely going to be no worse than it is and probably a heck of a lot better. So I don't think there really needs to be a whole lot. I don't think a whole lot will happen. Me and Freddie are getting better. They're getting stronger. Freddie just announced that they were actually positive earnings. Both of those companies are working really hard with really smart people to solve these problems, and we're getting there. So I don't think, I think just patience is a virtue, and the market will solve itself, and the governments can do, and it's just time to sort of move on.
I would jump back on and agree with that and say that I think the political will is probably gone out to interfere too much more with the housing market. The one thing that may come down the pike that I'm hearing about or seeing some evidence of is expanding HARP just a little bit more to allow homeowners who are not under Fannie or Freddie loans to be eligible for that as well. It's one piece of legislation that's been kind of sitting there that may be pushed through at this point. But other than that, I'm not seeing a lot of evidence that there's going to be continued interference, particularly in preventing foreclosures going forward.
I agree. I think if it was going to happen, it would have happened before the election. There would have been a bombshell. The tools are out there. They're in the toolbox. Servicers, as all, I'm preaching to the choir, but servicers don't want to foreclose. They want to help the borrowers in some way, shape, or form. We're at the point where the tools are there. You just got to grasp them and try to figure out what the right way out is.
Yeah, that's a really good point. And Brandon, I want to hand it back over to you, but I'll hand it over to you with a question because you're with PMH Financial, who has been a big player in specifically REO servicing for a while, or REO outsourcing. And I know that you guys have seen foreclosures themselves. What you're handling, your referrals go down a little bit. But what are the kind of things that you guys are working on or putting time and energy into to to push your business forward? Because I know that you got your ear to the ground, and you guys are networking with people that know where things are going. So I'd love to hear from you about what specifically you guys are doing.
Yeah, no, I mean, really a lot of the same things that the panelists today have talked about. Obviously, we've had a slowdown in our business in terms of the amount of referrals that we're getting. So we're in a similar position to some of the agents. We obviously we're going to stay a part of REO. That's part of our core business. That always will be. That's who we are. But ultimately, we also have to look at some other avenues that we want to pursue. So one of the things that we've been working on and working towards is looking at other streams and other types of business to get into. So, we've started doing more short sale work, more loss mitigation efforts, just to try and position ourselves to make sure that we stay relevant. And I think that as we've all talked about, you have to kind of go with the ebbs and flows of the business. And so you want to be committed to what we are. We know we're great at REO, but what tools does that give us to do other things? And so that's what we're in we're in that stage now where we're evaluating all those opportunities to say, okay, we have this skill set, we're really good at it, how else can we implement that, and what other forms of business can we participate in to take advantage of it? And so, we've talked a lot here about short sales, but that's just one of the things. There'll be plenty of other things that I assume we'll probably try and roll out this year that'll be a little bit different than what we've been doing.
Cool, man. Well, why don't you just go ahead with the next question or topic?
Yeah, absolutely. Well, we're getting up against it, so I want to make sure we don't take too much time away from these guys. So one of the questions I have for you is, one of the major news events this year was the DOJ settlement. And that felt like that just sent reverberations through the market the whole year. So with that in mind, do you guys have any thoughts or ideas? Is there going to be any kind of, as Scott said, bombshells that come out this year? Or do we think it's going to be kind of, now that we know President Obama is going to be back in office, is it going to be just more of the same, and we won't have any of these huge, upheavals in how business is done? Any thoughts?
Well, I just checked the markets down.
I said 4 letters CFPB. Sorry.
I was just on CNBC. The market's down 324 points. So maybe that tells you how people perceive how things are going.
Yeah.
Yeah. Interesting.
It's funny because I did a post on Twitter yesterday around around 12 noon, and I was looking at my retirement account, and I posted, why do I have the feeling that I should just sell everything? And as Apple's down 3, I could have sold it and then bought it back at a pretty nice discount. So now I'm pissed off at myself.
Scott Gillen, why don't you go ahead?
Yeah, and what we're seeing, I mean, you asked what we're preparing for, or what we're working on, going forward into 2013. A big part of what we're doing today and what we anticipate we'll be continuing to do in 2013 is trying to help, lenders and originators and servicers work through the, not only the DOJ settlement, the OCC oversight, and as I started to say earlier, that nasty 4-letter new acronym CFPB. There's a lot of unknowns in the marketplace right now relative to regulation, and the servicing standards leave a lot of ambiguity as to what servicers are going to have to do. I can tell you that we spent the better half of 2012 helping lenders get through and re-review files and make sure that they've done everything possible to try to help the homeowner, that they've given them that they've followed the loss mitigation waterfall and done everything possible. And I don't see that changing. I think, going forward, the CFPB will make their pronouncements in January. Servicers are struggling right now just to manage through everything that they've dealt with between the guys that are involved in the settlements, as well as the implications of the AG settlement and what that means in the CFPB world also. So, there's a long grinding year ahead of us to try to figure out how do we operate in this environment as servicers and as service providers to the servicers, and that's going to affect everybody, from the agents through to the service providers, to the borrowers, and there's a lot of unknowns right now as it relates to that. So If I had to ask what's going to dominate next year, I think it's going to be regulation, and I think it's going to be dealing with regulation and trying to figure out how to operationalize around what historically has not been something that some of these services have been required to do.
Hey, Scott Gillen, you work on a really interesting side that not a lot of our attendees here for this webinar get to hear all the time. So would you mind just real quickly, and then we'll move back to Scott Sambucci because he looks like he wanted to mention something about the regulation that you mentioned. But could you just real quickly explain the CFPB and what it is, and just maybe 30 seconds so that people understand exactly how to put the pieces together with your last answer?
I have to be nice, right?
Yeah.
The CFPB, the Consumer Financial Protection Bureau, it's a well-intended, regulatory body that was put in place, obviously, in a reactive environment, trying to make sure that going forward we did not have the same, problems that we had in the lending space, perceived issues in the servicing space, and in essence protect the borrower from, for lack of a better description, unscrupulous lenders or servicing activity, whatever the interpretation was at the time. As I mentioned, much of it is reactionary, like most legislation is. This is regulation around something that happened 04, 05, 06, 07, trying to put in place something that largely has corrected itself through normal, normal changes to the marketplace. So, from a lender and servicer perspective, they're very challenged right now in trying to figure out exactly, how to modify all of their procedures to, to stay in course with what they perceive the CFPB is going to put out there as rules for servicing loans and rules for originating loans. I think the biggest challenge of all is the CFPB has 400 rules to enact. They all have to be, they're basically announced in January, and in most cases, they have, the servicers and the originators can have a year to get up to speed and make sure that they're in compliance with those regulations. But most of them are just coming out of comment periods, and we're, for all intents and purposes, 2 months out from when a lot of them could start to go live. So, it is a challenge across the board, and I think, 2013, even in 2014, we're going to be talking about, how do we deal with the new level of regulation that we have in our space.
Yeah, on the regulatory side, I was just at the Mortgage Bankers Association meeting a couple weeks ago. We were with a very large lender, and they frankly said straight up, 2013 is all about regulatory for them, and I suspect it's the same. And one of the big, two or three of the big pieces of regulatory, one is Basel III, that I know a lot of people on the ground don't really think and talk much about, but it's just an international guideline on basically retaining risk and making sure that you're stress test for a number of end of the world scenarios. And within Basel, that comment period just ended in October, and the first round of regulations related to Basel come into effect in January of 2013. The hard part about Basel for a lot of the lenders is that there's very stringent capital reserve requirements for any risky loans. So if you're a lender with a big interest-only portfolio, or you just have a lot of high LTV loans over 100, then Basel would, under a regulation, the way it's proposed right now, would require certain capital reserves to be set aside, in some cases above 100% of the value of the loan. And so you've got to put money on the sidelines that you're not allowed to lend because you have to keep it just to meet this Basel guideline that is soon to become regulation through the Fed. That's frustrating, obviously, for a lot of banks who do want to do some lending. This year, in 2012, a lot of the regulation has been from the OCC. They have what's called ALLL. It's the allowances for losses on leases and loans. So if you're a bank and you have a second lien or second position mortgage, even if your second is performing but the first is not, you have to push that second mortgage into a non-accrual status. You have to take a loss on it. And so it's just a lot of work in general for banks. They got to dedicate resources to it that they don't necessarily have. It's good for our business because we help them solve that problem. But at the end of the day, if you're a bank, you've got to spend resources adhering to some of these regulations. That's time and money not spent working in the lending environment. So it's frustrating.
I would just add a comment on kind of piggybacking on the regulation is not necessarily bombshells coming in 2013, but it'll be interesting to see the in California, the homeowners bill of rights taking effect in January 2013. I think lenders are already preparing for that, and servicers, but the ones I've talked to consider that that's going to have a detrimental effect on their business and the loan origination business in general, and just the trend of either state legislation or state lawsuits against lenders, which we've started to see some of after that settlement has been finalized, and that's, I think, going to be one of the things to look for in 2013, is how those lawsuits or possibly state legislation is going to be impacting the lenders.
Great. Hey, I know we're running short on time. Brandon, are there any other topics you want to hit? If not, I'm going to ask one final question, and then we'll close it out.
I say you go for it.
Okay. Well, so here's the last question I just want to ask, and you guys can be however brief, or you can expound on it however you'd like. Moving back to short sales, how important are short sales going to be, or even currently, how important are short sales to the real estate market, and how big of an effect will they have in the coming years?
I'll jump on that one first. I think I would expect short sales to be a big part of the market for the next 5 years, if I were to have to put a guess on it, because we do still have a lot of folks who are underwater, and even as home prices are coming up, it's going to take time for those homeowners to get out from being underwater. Our data shows about 28% of all homeowners with a mortgage underwater, and so that's a lot of people, and many of those people are going to, for whatever reason, need to sell in the next 5 years still before they get out of that negative equity position. So I think it's going to be a big part of the market for the next 5 years. The one hiccup or wild card in that could be the expiration of the Mortgage Debt Forgiveness Act at the end of this year. Not sure. It's hard to predict how that will affect consumers, but that's what I'm seeing going forward.
Yeah, I got to agree. I think in many markets we're seeing huge percentages, and I allow the data guys to expound upon it more so than I, but we're seeing at Stewart, we're seeing large percentage of our closings being distressed sales and short sales. That's going to continue. There is no doubt whatsoever that if they do not extend the forgiveness provisions, it's going to affect short sales materially, though. And I think that we haven't talked about the fiscal cliff, and there's no reason to get into it in detail now, but that is a big deal and a wild card that we have to deal with.
My short answer on this is that it depends. I think yes, there's this preponderance of short sales, and it's getting bigger, and the REO sales are falling because the lenders and the investors are identifying short sales as an opportunity. However, as the market does improve, and a lot of the CoreLogic HPI data that we release, it shows these markets improving. It does. Some of those 20% that Darren mentioned will come out from being underwater, or at least get close enough to an LTV of like 105 or 110, where if they really need to get out from their house, they can go scrape up that cash from somewhere somehow. So I think it depends on how quickly and how stable the recovery really is. I think that could chip away at what would be a sort of a predicted number based on today's situation. But overall, I think that agents, if instead of I guess the final piece of advice for agents is, instead of thinking of yourself as an REO agent, think of yourself as a distressed housing specialist. Open up your personal education to not just saying, well, geez, that one's not an REO, so I guess I can't go work on that one. Understand what the short sale is. Look at Freddie Mac just released the short sale policy guidelines a couple weeks ago. It's very well articulated. Go get well versed on those things. Go talk to banks. Go talk to the lenders and understand all of these different scenarios. Go understand REO to rental and become the distressed specialist, not just an REO specialist, because if the REO market continues to shrink, and I suspect it will, then you're going to pigeonhole yourself. So, expand yourself, and I think you'll be in good shape.
Yeah, Scott, I think you just absolutely hit the nail on the head. One of the things that that I've been trying to tell, and like I said, I started up some of my brokerages as specific to foreclosure. We had clients who had a need in different areas, and that's how some of my offices opened. But all of those offices are slower now, and I have my agents or my brokers coming to me and asking me, hey, what do we do now? And a lot of the attendees on the webinar are frankly asking the same question. The thing I like about short sales is that it keeps you in the local market. It's not just waiting for a bank who's out in Denver or Salt Lake City or San Diego to send you a new listing. You've never seen them, you never talked to them, you have no idea what's going on. The thing about short sales, and even REO to rental to some extent, is it keeps you locked into your neighborhoods, locked into your local community, so that it actually creates larger opportunities, in my opinion, than REO itself. Now, our REO offices, and myself even in REO, developed a reputation so that, I get investors calling me wanting to buy houses. People would see my signs in the yard and they knew the name of my company. But the thing that, almost the negative thing that happened that impacted me was that I developed a reputation as a foreclosure guy. And so why would a person wanting to sell their home on the, regular market want to come work with a foreclosure guy? I sell foreclosures. So what short sales, when we started getting into short sales, the thing that really helped was the fact that I'm working with a guy who lives on a street and has neighbors and works in the community. And he's talking to people about the services that myself or my brokers are offering to them. And, it's just a totally different vibe. On top of that, he's giving me out referrals. And on top of that, there's a good chance in 3 years, statistically, I think over 80% of people will, after they go through a short sale, will try to buy another home 3 years down the line, and they'll come back to us. And so, we're getting signs in the yard, but we're also developing those long-term relationships with people that are going to continue to live in our local area and, ultimately stay as long-term customers. So I've really liked that part of it. Part of the reason that we put on this webinar is to highlight where the market's going. We know that this is, the information that you guys have all presented is going to be a benefit to, everybody attending. One of the things that we also want to talk about is a product that we've just created called the Short Sale Blueprint. Now, this has been REO Success TV and in correlation with PMH and Stewart. PMH's short sale department, their loss mitigation department, has been, studying this and actually handling short sales for, several years and doing it very, very well. And so they have been able to input tons and tons of valuable material on how to get short sales done. In fact, Brandon, do you just want to take a minute and talk about, what's gone into the short sale blueprint and what exactly it does offer to agents?
Sure. Yeah, the idea is that, as a lot of the agents who know have registered, is that, my goal was to help broaden that scope of business for agents. And so we put this course together as just as a lead generation / business building exercise in moving into short sales. And so the goal of it is to help you understand how to do more short sales. It's also to help you understand the lead generation side. One of the things that I think all of our panelists have actually touched upon today is just that business building element of it, and understanding that you need to be diversified. You don't want to be just an REO agent. You want to be the expert in your community. So we try and touch on several different phases of that, of just being the go-to market expert in your area. We've thrown in some elements about how to do more short sales, get them done more efficiently, as well as just getting more of these types of discussions from industry experts to understand exactly how the fundamental basics of short sales and what's important and how to move forward in your business. So it's a 4-part course. We've done some other ones here, and so this was just another attempt to get that out there in the market and help agents grow their business.
Yeah, we've interviewed guys that are very, very successful in short sales from the agent side. We've also interviewed the portfolio manager of PMH's short sale department. And there's tons of cool bonuses and perks, but the one thing I just want to leave you with is we didn't want to bring you onto a webinar and just talk more shop, just talk about, hey, this is where it's going, hemp, and all this stuff, shadow inventory that we'll never see or whatever. We want to actually give you a tool to be able to use for the things that we're talking about. you've heard, everybody mention the short sale, part of things. And, even if you don't take anything else away from it, know that short sales are going to be very important. So I want you guys to check out theshortsaleblueprint.com, theshortsaleblueprint.com. Check it out. There's a interview on there with Ken Blevins, the CEO of PMH. He's going to talk just a little bit about the importance of short sales. You've heard all these guys talk about it. And we just hope you'll at least take a peek at that website. And if it's good for you, it's good for you. If not, it's not. We'll give you some free information on there as well. So, gentlemen, thank you all so much for being with us. I think I was really kind of riveted by this discussion because I'm a little bit of a nerd when it comes to some of this stuff, and I like to know about it. So we appreciate each of you taking the time with us today, and I'm really interested to see where things are going in the future. So, Brandon, is there anything else you wanna hit?
No, I just want to say thanks again, guys. I reached out to Scott Sambucci. I've known him for a couple of years, so I thought he'd provide some great insight in data and analytics. Darren, this is the first time we've actually met, but we've been talking to RealtyTrac about exactly what we're working on with the short sale blueprint, and so we're excited that we're working with them on it and to help bring it to market. And then with Scott Gillen, obviously stepping in for Ken. We had promoted it with Ken being on board, but Scott, like I said, is so knowledgeable in the space and actually has a ton of initiatives going on here at Stewart. So not only could he speak to what we're working on here at PMH, being a Stewart company, but other Stewart initiatives that are more broad-based. So I just want to thank each of you personally. I know it's always hard to do the day after the election. We all have other activities that are probably super pressing. So thanks for taking an hour out of your day to hop on with us.
Thank you.
Thanks, guys. Have a great day.
Yeah.